Welcome back. I hope you enjoyed that exercise. Now it's time to move on to the final type of equity model for today, quantitative models. Quantitative models, also known as quant models, are highly sophisticated, data-driven equity models that have a little bit of overlap with technical models in terms of how they're operated, but are based on a completely different methodology. Like technical models, quant models are built and managed by feeding a large amount of financial data into an algorithm, into which logic is also built to recommend trade ideas. But that's where the similarities stop. Rather than making trade and investment decisions based on simple historical market data like price and volume, quantitative models are driven by advanced mathematical and statistical models and are on the cutting edge of modern buy-side finance. In order to understand how quantitative models work, you first need to become familiar with a concept known as factor investing. Factor investing is a strategy. When an analyst or an advisor says that they're using factor investing to drive their investment decisions, what they're doing is choosing stocks in their model based on specific attributes that they believe are associated with positive returns. These attributes or factors can be grouped into two main categories. These are macroeconomic factors and style factors. Macroeconomic factors are attributes that capture broad risks across asset classes, like the unemployment rate, GDP growth, and the rate of inflation. You may remember some of these concepts from our previous FPWM course on economics. Style factors focus on the risks and returns within a specific asset class, like market cap, industry sector, and comparing growth stocks with value stocks. By investing based on factors such as these, the advisor's model theoretically can enhance portfolio diversification, generate outsized returns, and better manage risk. Creating these factors is part of the specialized skill set that analysts who build these types of equity models have, and the combination of factors are almost limitless. However, we're going to take a look at 5 foundational key concepts that are integrated into modern factor investing so that you can get a sense of what's out there and whether or not it aligns with your own investment philosophy and potentially your practice. The first key concept is value. Value focuses on identifying stocks that have a low market price relative to their fundamental or intrinsic value. If this sounds familiar, you're right. This is a core component of fundamental modeling as well. This factor is typically tracked by the price to book or PB ratio, price to earnings or PE ratio, and free cash flow. The next key concept that's often included in factor investing is the size or the market capitalization of a company. Often, small cap companies fall into the higher risk but higher reward investment profile, while larger companies tend to produce moderately safer but lower return investment opportunities. Investors can include this logic in their model decision making to pinpoint specific risk-adjusted returns. Momentum is another factor that can be very important in equity models. Companies that have consistently outperformed in the past have a higher probability of continuing to outperform in the future. By looking at relative returns over a 3-month to 1-year timeframe, analysts can use models to identify the best momentum-driven future opportunities. The fourth key concept to familiarize yourself with is quality. Quality companies tend to have low debt, stable earnings, consistent asset growth, and strong corporate governance. And last, but definitely not least, is volatility. Often, we see that stocks with lower volatility outperform companies with higher volatility. Measuring standard deviation from a 1 to 3 year time frame is a common way to capture volatility and include it in a factor model. Just like with fundamental and technical models, it's very important for you as an advisor to put some time and thought into the value proposition that you bring to your clients by integrating quantitative models into their wealth management solution. Frankly, quant models are a bit like technical models in that they aren't for everyone. Your typical wealth management client with an average amount of investment experience and level of sophistication is going to gravitate towards classic, bottom up fundamental analysis that will help them grow their portfolio steadily with minimal risks. That said, there is a place for quantitative models in many advisors' practices, especially when working with very high net worth clients who potentially already have a large, well-diversified set of holdings and are looking for either additional diversification or enhanced returns. When communicating with your clients on these types of models, it's important to have a strong rationale behind the specific factors that are included in investment decision making. For example, if your model screens for companies that have a high level of free cash flow, you'll want to be able to articulate that free cash flow is a key predictor of a company's strength, and that historically, companies with strong free cash flow have tended to outperform the broader market. Or if one of your factors looks at companies that tend to conduct share buybacks on a regular basis, you can speak to the performance benefits that come from preferential tax treatment in these buybacks. Additionally, much like technical models, you can lean on the strengths of using an algorithm to support investment decision making. A properly constructed model and algorithm seeks to minimize or eliminate the kind of biases that are inherent in all of us, and that will really resonate with a broad range of clients.